We had that letter come out, and it was signed by people like the head of Nike and head of Adidas saying this is really a big problem for us as retailers. Is it a big problem for Columbia at this point?
Well, we signed on to that letter as well. I mean, frankly, we believe these tariffs and trade wars are ultimately bad for American consumers and really bad for consumers everywhere. So we believe that this kind of difficulty in global business is very significant and a headwind against really all of us. So we're spending lots of time in the company managing our sourcing operations when we should be managing our sales operations. So this is a very disruptive event for us.
Do you see at this point or in the near future an effect on your margins?
Well, we have a very broad sourcing operation. We source in 19 countries, and frankly, China represents only a high teens % of our total importation into the U.S. But you know, it's disruptive. It's causing problems, and we're spending time on this topic when, frankly, we should be spending time selling our products globally and taking advantage of the technologies that we've invented here in Portland and the brands that we've established here in Portland.
If this continues, this trade dispute between the United States and China, and for that matter, if it gets worse and more tariffs come on board, how realistic is for you to resource, even the high teens, as you call it, percentage from China, and where would you do it? Is it Mexico? Is it Vietnam? Where would you go to?
Well, we source almost exclusively from Southeast Asia, although we have some production in the Americas. But this is all tariff related. I mean, our products, footwear and apparel, are among the most heavily tariffed commodities since really the 1930s. So our company is quite adept at moving production around to take advantage of tariffs. As an example, much of what we import into Europe is sourced in Bangladesh because there's no tariffs in that area, and so it's an advantage of about 15% for the company when we're sourcing products into Europe. These tariffs exist between almost every country that we work in, but you establish a relationship with a factory, you have intellectual property and established processes for doing business, which you can't replicate in 2 seconds moving around to some other factory. So these are important relationships we want to keep, and we have to focus on building these, and hopefully our business will be around a lot longer than the Trump administration.
Your sourcing you might feel comfortable with your sourcing, but if some companies then have to move to other countries in Southeast Asia, like Thailand, like Bangladesh, are you concerned at all that that's going to increase your costs then in those areas?
Absolutely. I mean, we're already finding competitive pressures in those markets, and this will continue. The big issue is really the uncertainty that we face in terms of trying to grow our business. We're spending way too much time worrying about Mr. Trump's trade war as opposed to selling our products.
So then to that point, are you passing along those price increases? Are your customers able to withstand that? And will you be able to do that for the next year or so?
We will pass on the prices if we have to. So again, these are taxes on commodities that American consumers are going to be purchasing. So yes, these taxes will be passed on.
And what about your experience with the consumer in the United States? So we hear the consumer's in pretty good shape. Obviously, employment is very high. There's real wage growth. Do you see any pinching of the consumer at this point, or are people coming and buying?
Well, actually, I'm surprised how strong the consumer market has been. Although, we sell products in the central part of the United States, and our business, our home here is in Portland, Oregon, which is one of the largest exporters of soybeans in the United States. So obviously, as that business goes down to the business in China, we will expect consumers in some markets to be more damaged than others.
Well, you raised an excellent point, Tim, and that brings me to what your visibility is really like for the next, say, 12 to 18 months.
Well, who knows what's going on in Washington? I mean, frankly, this is why we have such a strong balance sheet in our company, to be able to withstand issues like this, which can come up from time to time. But again, we would prefer to spend our time and focus our energies on selling our products globally as opposed to worrying about a certain market.
So, Tim, fair, but does that mean that, is there any sort of capital allocation or investments that you're holding back on making because you don't have that visibility, or are you just kind of trying to have tunnel vision?
Well, we measure every one of our capital investments here as based on what we expect the business to be in the future. And certainly, we've put distribution projects on hold. We've moved them around the world to take advantage of where we know business is going to be, to have more certainty than we have in the near term here in the U.S.
So, Tim, let me ask the flip side of it. You're a global company, so you have employees around the world. But in terms of employees here in the United States, are you starting to see some wage pressure? Because it is a very robust employment situation.
Well, there is very significant wage pressure. Here in Portland specifically, this is the home of the footwear business in the United States with Nike, Adidas, Keen, ourselves here, based in Portland. This is a very competitive market here. But we find probably the largest change in in payroll rates happening in Southeast Asia, India, Vietnam, and those markets. They're very, very inflationary.